Hi, I'm Jimmy. In this video, we're looking at Disney stock, ticker symbol DIS. Now, this video is actually part of our new series we did before, but we're doing it again, and that is our Dow 30 analysis. Now, we actually started this series at the beginning of last year, but we never ended up completing it. So what we're doing now is we're starting here, we're starting at Disney, which is the Walt Disney Company, and we're going alphabetically according to the 30 companies in the Dow Jones Industrial Average, reverse alphabetically, right down to until we get over to 3M. Then what we're going to try to do is pick our top 3 dividend stocks, top 3 value stocks, and top 3 growth stocks. Now, one of the reasons that we're doing this analysis is, as many of you may know, we're actually trying to build a website where we can quickly and easily value companies. But not all companies should be valued the same. Discounted cash flow, which is my favorite valuation method, works very well for a company like Disney. That's what we'll be using in this video. But it doesn't work nearly as well if we were to look at a company like Travelers Insurance. Well, that doesn't work nearly as well. JP Morgan down here, again, not nearly as well. So we're trying to get our website up and running. First, it's going to work with discounted cash flow. Then we're going to add all different types of valuation methods that ideally you punch in the ticker for the company that you're interested in. And when you do that, well, the fair value is automatically calculated using the most appropriate valuation method. Sometimes more than one could be useful, so the website will warn you to that. And as we can see, this is sort of how it'll work. You punch in the ticker, fair value gets calculated based on whatever our required rate of return is. So if you'd like to sign up for this website before it's built, we expect it to be done by the end of the second quarter of this year. Well, I will put a link in the description below for how to sign up. And if you do sign up now, well, we're locking in your price, so your price will never go up on you. So again, link in the description below. But for now, let's jump back to our Disney analysis. So according to Disney's 2021 revenue, well, this is how they break out their revenue. They have 76% in their media and entertainment division, and then the other 24% in their parks, experiences, and products division. Now, these segments can be broken down even further into domestic channels, international channels, direct-to-consumer, that's something like Disney Plus, their content sales, their parks and experiences, and again, the consumer product sales in those segments. Now, in my view, one of the most interesting and exciting parts of Disney is their direct-to-consumer business. We can see that currently represents 24% of their overall business. Now, this is according to 2021. We'll come back to that in a second as to why that's important. But that's 24% of their overall business. A few years ago, this didn't even exist since Disney Plus is fairly new. And from a business perspective, I actually find this to be very interesting for a company like Disney or any content creator, because as the world evolves and streaming services gradually take over how we receive things like movies, sure, I believe movie theaters will still have a place in the world, but there's going to be a certain amount of revenue that companies like Disney are able to skip right past the fees, the portion of that revenue that movie theaters take, and they go direct to the consumer. I think potentially that has a big chance to become a rapidly growing piece of Disney's business. So far in the past 2 years, that has proven to be true. But with that being said, let's jump over to Disney's revenue. So this is a chart of Disney's revenue going back to 2007. Now, the orange bar is the last 12 months, and the 2 green bars in this example, green bars are analyst estimates. So I just want to distinguish between those. And we can see analysts are expecting those numbers to ramp up. And up until 2020 and 2021, well, the trend looked like it was going to start moving higher. And then 2020, which we know was COVID, well, that really slowed things down. And 2020, specifically for their parks business, well, that has also kept things. Yes, they've opened back up, but their revenue wasn't quite as robust as it was back in, let's say, 2019. But again, it looks like numbers have already turned higher with the orange bar, and analysts are expecting for that growth to continue. Now let's jump over to their profit, because that tells a little bit different of a story. Now, when we look at 2019, well, 2019 was a little bit unusual because in 2019, Disney bought the majority stake in Hulu. Now, they already owned a piece of it, but then in 2019, they took majority of it. So when a company only owns a piece of the overall business, well, they don't report all the numbers. They just report the part that applies to them in their financial statements. But once they take majority, even if they only take 51% of that business, once they have majority control over it, all of the expenses come on over. Well, with those higher programming costs, as well as some increased costs in the operations of their Fox business, well, that increased their cost of goods sold, which reduced their overall profit. So we saw that their revenue was increasing higher, but their profit started to head lower. Now, 2020 and 2021 are probably much more obvious. Now, I do think we should point out that Disney's fourth quarter technically ends at the end of September, so it doesn't go to December, which is why in this case, it looks like 2020 was not as bad as 2021. And that is because, at least here in the United States, most things for COVID started to shut down at about the end of the first quarter, so heading into the second quarter. So they would have had about 2 quarters really impacted from the closing of all their parks and all of those issues. Plus, they had increased costs from the development of Disney Plus, which we already saw is helping and it's ramping things up and becoming a bigger piece of their overall business. But as the parks gradually open up all around the world and the added expenses of launching a new platform like Disney Plus, those technology costs gradually go away, well, we can see that analysts are expecting for profit to continue to move higher. Now let's jump over to the free cash flow. Now, when we look at this, we can see that free cash flow looks very similar to net income. Or net income is the same thing as profit, by the way. But one of the things that caught my attention is their 2019 number for free cash flow. We can see that is much lower than their profit number is. Now, one of the reasons for that is that they had a big tax hit in 2019. So that brought their overall free cash flow down much lower. But once again, we can see that analysts are expecting for free cash flow to gradually ramp up over the next few years. And it seems that in about 2025, 2026, that the previous trend for free cash flow is expected to continue higher for Disney. And I, again, want to reiterate that for me, in my mind, their direct-to-consumer product is one of the potential drivers of this increase in free cash flow. Okay, now this brings us over to our discounted cash flow calculation for Disney stock. So using our discounted cash flow tool, well, first we got our 3 years of analyst estimates. These are the numbers in green. And then I actually adjusted some of the further analyst estimates that I could find, and because I thought that they were a bit too aggressive. So this 2026 number here, yes, it is very possible that they hit that number, but I thought it was a bit too aggressive to project that going out so many years into the future. So what I did is I toned that down a bit to just short of $11 billion. And then I gradually decreased the growth for free cash flow going out a total of 10 years. And using those numbers, sure, somewhat toned down numbers, well, using my required rate of return of 7.5%, I get a fair value of about $104 per share. Right now, Disney stock is trading closer to $130 per share, so it seems that Disney stock is overvalued right now. Now, personally, I own shares of Disney, and I actually bought these shares when they dropped below $100 per share because I actually had the fair value somewhere near this level, so I thought it was a very good buy at that time. Right now, it seems overvalued, although I have no intention of selling this stock because I do think that big picture, they have a big upside opportunity. Now, we can see over here that they're actually showing no dividend at the moment. And that's because back in 2020, they actually froze their dividend, which to me makes a lot of sense. If the company's struggling, I'm not one of those that obsess over whether or not I get a dividend. So I was okay with them doing it while they were ramping up expenses to hopefully position themselves for future growth. That being said, I do expect them over the next year or two to gradually come back to a dividend and then start increasing it once again. But I'm hoping it's not terribly high. I would expect it to be in the 1, 2, 3% range, something about where it was before. Now, if you'd like to get access to this website where you can punch in your ticker, get the fair value of the stock, I will leave a link right here. I'll leave a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.